Thank you very much for joining us on this webinar. Today is Thursday, the 9th of January. For those of you that listen to this recorded, just to say that we're going to be running through the next kind of 30 minutes or so, and we are encouraging everyone that is listening to this live, please do feel free to put any questions that you have into the Q&A. We are really trying to make this as interactive as possible. I've been joined by some of my colleagues. My colleague, Cleona O'Donoghue, is going to be kind of managing the questions that come in. We have already had quite a number of questions over the last week or so, which we will address during and towards the end of this webinar. And I'm going to talk about personal finance and kickstarting your financial plans for 2025 and beyond. And just before I start, just to mention, we're going to pop up a poll just while we're waiting for the numbers to settle. So if you don't mind, you might just respond to that. And I'm going to just talk a little bit about Alpha Wealth just while we're doing that. For those of you that are not familiar with us, we're basically 11 people based in Cork and Dublin. We provide independent financial guidance to individuals. Some of you may have dealt with us previously, but those of you who haven't, I want to try and impress upon you that we are very, very conscious about making sure that we can add value to all of our client meetings. So just to get through, because it's quite a bit that I want to run through today, I'm going to talk a little bit about four main things really that I want you to take away from today. Firstly, about how to establish your financial goals and to make sure that you meet them during the course of 25 and beyond. How to reduce the tax you pay, making sure that your money is working as hard as possible, and also then this notion of financial independence, putting you into a position in the straightest path possible to be able to retire or semi-retire earlier. So to start with, as an icebreaker, this morning I was listening to news talk and there was a lot of talk around mortgages and the fact that house prices are being sold for on average about 9% above asking price. There's still a lot of demand in this area, and that the average mortgage is about 308,000 euros. Now, in terms of how we can help clients, and as a quick takeaway, we don't provide mortgages in Alpha Wealth, but we give independent guidance to individuals. And we work with a number of mortgage brokers. We help people assess what mortgage they're on for those who have a mortgage or for those that are looking to buy a property to get the best mortgage possible at the lowest rate and to navigate the fact that interest rates have fallen four times over the last 12 months, whether it's time to either fix, refix, or to stay variable for a while. And I'd like to suggest that we can add a lot of value and help people save thousands upon thousands of euros in that one area alone.
Nick, before you jump on, we asked for this session to be as interactive as possible, and we have already had a good few questions in. So thanks for the questions. I'm going to pop one of them into you there now. Is it a good time to sell a second property if you're still paying a mortgage on it?
So if you have an investment property, the general rule of thumb for me is you should certainly put yourself in a position to be able to sell. And what I mean by that is that if you've got a tenant in your property, you have to give them legally 6 to 9 months notice. The starting point might be to offer them whether they would be interested in buying your property. It saves you a bit of time and money. But only by giving them notice can you make a decision in 6 to 9 months from now whether or not you decide to sell. And the market has been very hot. There is talk, and again, if you listen to the press, which will be in the news tomorrow, they're talking about this softening of house prices. You know, this continued demand is starting to be met by supply. And I'm of the opinion that the government don't really favor landlords. And I certainly feel that it may make sense, particularly if you have a mortgage on that property, to consider that. But the main thing is, does it achieve a price that you're able to sell for? Because it's easy for me to sit here and say, yes, you should consider selling. But the key thing is, do you get that price that makes it palatable for you? Okay, just to move on from that. So the first thing I always say to people, particularly at this time of year, is set out some financial goals, write them down on a piece of paper, put them onto an email. And it's a great reminder just to refer back to. And it's something that I suggest that people do every year, whether it's trying to help your children get through third level education fees. becoming financially independent early, which is one of the main things that we work with clients with, trying to reduce the debt you have. Christmas is a very expensive time. I was talking there on Red FM just before Christmas, and I'm always surprised by how little people think that they spend over that period. I know myself, just by virtue of the various different things that we pay for, going out, Christmas dinner, presents, and so on and so forth, it can rack up to thousands upon thousands of euros. And it's really then just trying to get back into a position of saying, okay, well, how can I address the debt that I've had to bear? How can I make sure that I'm in the best position possible for myself and meet those objectives that I have? And the starting point normally for me is the financial budgeter. I've spoken extensively about that. There's a lot of really good tools available online on the Alpha Wealth website. We have a free financial budgeter that you can download, and encourage all of you to do that if you haven't already used the budgeter this year. And just what it does is it allows you to just put down on paper, on an email, spreadsheet, an ability to kind of get a sense of where the money is going that you get into your household every month. And then you can use a financial planner like Alpha Wealth to help you assess whether there's any superfluous income expenditures that you have. And we help people reduce the cost of insurances. I'm going to touch on that briefly today, but also reducing the cost of things like your mortgage and helping you just to find the right balance. A lot of what I do as a financial planner is just helping people balance their finances, typically into three different pots. I talk about compartmentalizing, and I refer to the short, medium, and long term, which I'm going to talk about there in a moment. So just on that, whenever I say to people, okay, we're all striving to reach certain financial objectives. We either want to buy a car in the next year, 3 years, 5 years. We want to try and buy a property, or maybe get onto a bigger property, or we want to try and retire early. And what I say to them is that you've got to fit them into those three different compartments. The short term, I typically refer to everything less than 3 years. The medium term is at 3 years to what I refer to the age of independence. I'm 51, so I'm aiming for 60. That's obviously a 9-year term for me, but obviously it varies depending on what age you are. And then the long term is at your last third of your life. It's the 60 plus, where you hope to be able to kick back a little bit. It might be kind of semi-retirement, or giving the ability to work less hours, or indeed change careers or jobs to something you may enjoy doing more.
So Nick, you put up a poll at the beginning. 70% of people said that they had set financial goals, 30% haven't. How important is it to set financial goals? I mean, you mentioned we've come out of Christmas, a very, very expensive time of the year, and people may have overspent. What advice would you give to people in terms of setting out these objectives in terms of the short, medium, and long-term goals?
I think it's really important. Okay, and I'm not going to try and preach to people and sound like I'm in any way giving guidance. I overspent at Christmas. I know myself, I did. The key thing is to try and spend within your means. Be cognizant of where your spending is. And I know we all strive to kind of start resolutions in January that we want to maybe eat a little bit healthier, drink less alcohol, for example, and spend less on things maybe that we were spending our money on. And naturally that will happen. We don't go out as often, perhaps, let's say. But the main thing is really it's a case of getting a sense of, okay, I understand, because they always talk about, it's hard to get to a destination if, in terms of mapping out your journey. If you don't have these objectives set out, it's really hard to understand and strive to actually achieve something. And I say that as a parent of 4 children in a blended family, having started a business 11 years ago, and having to navigate all of the different challenges that are thrown at me financially, and also things that I need to obviously pay for, such as paying for children in education. I have a son at university. I've got 2 children in secondary school fee paying schools, which I hadn't anticipated. And these are all things that I have to plan for, and obviously make sure that I can mitigate against the funds that I've achieved. So just to kind of refer to, let's talk about the short term. The reason why it's really important to make sure that your money's earning interest, and this is why I talk to people about looking beyond certain banks or indeed the credit union and post office, is the effect of inflation. And people don't always recognize this, but inflation will erode the value of your savings. And even though inflation has fallen in the last 12 months or so, we're looking at inflation rates of somewhere around 2%. Even at relatively moderate levels, over a period of time, it's going to significantly reduce your wealth. And that's why it's really important. I say this to everybody. For every euro you have, whether it's in the short, medium, or long-term compartment, you need to make sure it's earning at least the 2% net rate, because otherwise you're losing money. And there's a simple solution to this. A lot of people ask me about where they should invest their money. They talk about investment opportunities. Bitcoin, for example, there was a lot of mention of Bitcoin late last year, primarily due to the Trump election, obviously his involvement with Elon Musk. And I say to them that that's not really an investment. That's speculating. I have no issue with somebody who wants to buy Bitcoin, but it needs to be done as an overall strategy, and it needs to be commensurate to the other investments that they have, because it's a very high risk investment. You're not going to put everything you have obviously into that. And we've seen deposit rates starting to fall over the last year, but there's still rates that are attractive out there, which I'm going to touch on. We've seen commodity prices increase, primarily gold and coffee prices. Now, obviously, I don't expect people to go out and buy lumps of gold and put them in the back garden. I have met one or two people that have done that. What I'm saying is that it's an understanding of looking at a portfolio and making sure that you've got diversification. It's the old adage of not all eggs in one basket. And I'd like to suggest that we are experts in giving that independent advice to individuals. Looking at the short term, and this is really referring to those banks that I've touched on. Every one of you should have monthly savings going into a bank. It could be as small as 10 euros a month, but it's something that we all require because we all want to do things in the short term, that 0 to 3 years. Things like paying for a holiday, next Christmas when it comes up, that we're ready to be able to spend the money that we've obviously saved in that period, maybe buying a car in the next year or two. And there are accounts, AIB, Bank of Ireland, online savers. There's PTSB that offers a slightly lesser rate, but again, not far off the 3%. And yet many of us are not saving into that account. They've just got money kind of lying around in banks, not really sure of what they're doing. The credit union are paying 0% dividends. They're telling you they don't want you to save with them, and yet many people are still continue to do that. And I'm struggling to understand why they only want people to borrow money, which is why they've effectively not increased their deposit rates at all, despite the increase that we've seen in interest rates. Lump sums. Many people have money still sitting in the likes of AIB, Bank of Ireland, and so on. You can get 3% with regulated banks in Europe. There's a number of them that operate in the market. And for those of you that are not familiar with banks like Trade Republic, Raisin, Bonk, and so on, we've seen many banks that have come into the market, but Revolut are the one that everyone knows of. Now, Revolut are not the most attractive of those banks when it comes to paying interest because they were first to market. They don't have to be quite as competitive because they've won people's trust, but at least they've opened the door. And all of us generally tend to use Revolut now, maybe not so much for our savings. And all I'm saying to you is that if you take that a little bit further, you can benefit hugely from these. I had an article published there yesterday on the 8th of January, just in respect of some of the things that we can do to get our savings working harder. But as you can see there on the screen, 9 out of 10 people in Ireland, and we hold huge amounts of money on deposit, are still earning next to zero on their deposits. And with the greatest respect, that I think that's like unacceptable. It really is. I'm saying to you that there is absolutely 3% interest available for your monthly savings and also for any deposits that you have. Keep your bank accounts relatively small and make sure that you've got your interest in those accounts that are instantly accessible. I use Trade Republic and Raisin. Revolut, for example, who are on the screen here, they currently pay 1.7% for instant access savings. So at the very least, for anyone that has a Revolut account, that's the rate that you should be getting. but I'm saying to you that you can get 3% with equivalent accounts with zero fees, and I'm encouraging you to take advantage of these. Revolut have advertised these flexi cash funds. They're trying to entice people to go into higher interest accounts. That's the one in the middle of the screen. But by doing so, you're going into more risk because you're taking exchange rate risk in dollars and in sterling, which I think is unnecessary. And also the tax on those accounts is higher, where they've been very cute in providing the net interest to you, which is lower, significantly lower than the advertised rates, as you can probably see there on the phone. And I'm saying to you, you just need to get a little bit of advice and guidance on that. Moving on from that, why is it so important? Just to really hammer home this message, for anyone who's, let's say, saving for a property and they're saving €1,000 a month over the next, say, 3 years, you'll accumulate €1,000 more by earning 3% versus 1%. How significant is that? If you had a
Nick, on
deposit
that,
today,
can you
yeah,
maybe outline, because the question has come in, to tell people who is paying 3% with zero fees currently?
Raisin and Trade Republic. They're the two banks that I'd encourage people to open. They're really simple to do. I use them myself. I encouraged my father-in-law to put in funds into Raisin Bank recently, and it allows you to use any of the banks operating in the European market under the deposit guarantee scheme. A lot of those banks are superior in security to the Irish banks, and they're very simple. But because of lack of maybe knowledge, or I suppose a perceived perception that they're not the same as the Irish banks, people are still not taking advantage of those. And it is the way of banking. The Irish banks don't want you to go into their institutions anymore. So I'm not sure why people won't do that. And by the way, the monthly savings, they are the Irish banks, AIB, Bank of Ireland, the best two. And I'd encourage all of you to open those accounts with those institutions. If you bank with Bank of Ireland, you can do it on your app online. It's really, really simple.
And just talk to me about accessibility of your money in these banks as well, Nick.
You can access the monies after 24 hours. Some of those accounts in the likes of Raisin will offer you options to lock in for a period of 6 months, 12 months, 24 months, and so on. In most cases, it's not really necessary. You can get the same rate on instant access accounts. But if anyone needs a little bit of advice, we're available to help you. Again, I'm not here just to give you some information and leave you off on your way. We provide a comprehensive service, and I'm going to talk about that at the end as to how we can help you with all of the areas that I'm touching on today. Just moving on, because I'm conscious of time as well. In the medium term, that 3 to, in some cases, 20 plus years, depending on your age, that's not the bank accounts. If anyone's saving for a property or a car in 5 years from now, you should not be saving in the banks, not even with Raisin or Trade Republic or any of these other institutions, because you're not going to get a positive return once you allow for inflation. And you can do a lot better looking at alternatives. There are insurance companies that provide savings accounts which are superior to those. I encourage people to at least educate themselves to those options. We have set up recently what we call the Alpha Savings and Investment Club to make this easier for people, where we're providing this account, giving returns 5-6% plus a year with access to your money, extremely low fees, no entry fee, no exit fee. And it allows you the ability to save from €100 a month or more, to put in lump sums, typically of 5,000 plus. And these accounts will be significantly better, in my opinion. And we can prove this to you, showing you the returns that you would have generated over the last 12, 36, 60 plus months, and why these accounts certainly is something that you should strongly consider. These accounts you may have already seen, the likes of Irish Life, Zurich, and so on. If anyone has these accounts, ask yourself what fees you're paying. It's really important. One of the biggest erosions of returns are paying high fees. And I'd always challenge people by saying to them, you might have the right type of account, but you may be paying too much for it. And it's really important, because even though it may not seem like a big deal, it can amount to thousands of euros over the course of the term that you have these policies for. And as I said to you, these are completely accessible accounts. And I strongly encourage people to look at these and indeed seek out more information and educate yourself as to what the options are. I just want to touch on the long term. And again, there's information on our website. We've done previous webinars talking about retirement planning, and we provide free webinars for individuals, and we're going to continue doing so throughout the course of the next few weeks and months. But just as a quick, I suppose, indicator of long-term savings, and it doesn't have to be just a pension scheme, but for all of us, we're all going to stop working at some point. And all I'm saying is that we want to have the straightest path possible and have some sort of understanding of what that looks like. In Alpha Wealth, we always start the process by showing our clients where they're currently likely to finish up on based on what they're currently doing. So for example, if you're a member of a pension scheme at work, we show you specific to you what that would likely to be worth when you reach a certain age. Now, some people may see that from a templated report that they get maybe from their provider, but it has to be specific to you. And then we show you what differences there will be if you make slight adjustments. If you incrementally increase it by 10 euros a month, what difference that would make. And you start to really understand the power of taking a little bit of control. You don't have to be an expert. You just have to recognize and understand that those three pots that I refer to, the short, medium, and long term, that you've got money going into each of those because you're going to always have requirements in those three different things. Things you're going to want to spend money on 5 to 10 years from now that you probably haven't even thought of, you should start saving for, even if it's only a very, very small amount. People tend to focus too much on the short term because obviously it's the thing that they can see, coming sooner, but they often forget the long term. Now, again, I appreciate after Christmas, it's very hard to sort of start thinking about your pension. But I'm saying to you that you're probably already doing something. And it's important just to say to yourself, okay, well, maybe I can get an independent assessment of where I am, get a projection from Alpha Wealth. I can see what I'm likely to hit when I reach 60, typically. That's the age that I try and suggest to people that they should try and aim for. It may not always be possible. What does it look like? And where am I trying to aim for? And I'd always say to people that the state pension in Ireland, where if you've worked for 10 years, you'll be entitled to, is actually quite attractive. You only need 10 years. You need 35 years in the UK to get the full pension. And I'm going to touch on that in a second. But that's worth about 200 to 250,000 euros to people. If you live from 66 to 80 odd years of age, 14,000 a year, simple math will tell you, you will benefit to the tune of about 200 plus thousand. So if you can build up a bit more of a bridge for yourself by making contributions through your employer or that you make contributions yourself, and many of you may have pensions, maybe from a previous employment, really important to get an assessment of where those pensions are. Don't forget about them and make sure that they're in the best funds possible. And this is something that we help our clients with. But if you can get up to a total of about 600,000, including 250 of that from the Irish state, 350,000 off your own band. It doesn't have to be a pension. It could be an investment property. It could be other investments that you have. That, in my opinion, would give you an income of about 40,000 a year. And I believe that will sustain most of us throughout our last third of our lives, that fun time that we refer to. And again, we work with clients and we do these reviews annually to show people, because it's really important that whatever you decide to do in 2025, make sure that you revisit it in 26 and so on and so forth. The
So
biggest
Nick,
mistake most of
sorry,
our
I'm going to
clients make.
interrupt you.
Go on.
I'm waiting for a natural end to your conversation there, but there's no end. So I'm just going to interrupt you because a few questions have come in, and there are obviously people that are thinking about their pensions. I'm 47 years old and currently maxing out my pension contributions at 25%. Should I keep putting in as much as possible?
As long as you can meet your short or medium term goals, absolutely. Whilst to
And
some people it might seem 25% is extreme, let's say you're earning 50,000 euros a year. So 25% of that obviously is 12,500. That may seem like a lot to be put into your pension. It's about 1,000 a month. But at 50,000 income, you get 40% back from the government. So it's only costing you 600 a month. That's around 7,200 for the year. then it starts to become, okay, maybe this makes sense because of the tax relief that I'm going to get from the government.
And what about for a person who said they are a teacher? Are AVCs a good way for a teacher short on years for their pension?
Absolutely. AVCs make sense. And again, we've worked specifically with teachers. I did a webinar for teachers about a year ago that we can share with you if you want to reach out to me, and I'll give you my email address at the end. But you have to have the right ABCs. Corn Market and IPS tend to focus on teachers. They typically use Irish Life. Their fees tend to be quite high, but the concept of what they're trying to give you is good. Now, you can choose whichever provider you wish, and I think it's important to get that independent advice. But AVCs give you the ability to be able to retire early. And as a teacher, you can retire from the age of 50 onwards. Now, for some teachers, obviously, that may or may not be possible, but certainly I think it's putting you in a better position. Just remember, every €100 that you contribute towards your pension, it will cost you either €60 if you're earning over 44,000 a year, or €80 if you're earning less than that. What a really good investment opportunity. And it's basically buying months, if not years, of your working life every time you do that. And by the way, all of us are going to be better off by about €70 this month when we get our paycheck this month because of the budget changes that took effect in October. Make sure that you do something progressive with it, because otherwise it become part of this, what we call living creep, where we just end up absorbing that and spending it, unknowns to the fact that we've actually improved our financial position by that 70 odd euros.
And one last question just on pensions, and there are loads of questions, and don't worry, we will get to a lot of the questions. The UK state pension, what's the closing date for that, Nick?
So, without exaggerating, I'm an expert on the UK state pension. I've spoken extensively about that. I had an article published in the Sunday Times last Sunday, and I successfully applied for it under Class 2, which is the cheap of the two classes. I'm doing a webinar on the 23rd of January. I'm going to be giving people everything they need to qualify. The closing date is April, but you need to apply no later than the middle of February because there's a long delay in the application process. However, the the deadline for April allows you to go back basically 18 years. So for example, I left the UK in 1999. I was able to claim all of those years back to 2006. If you miss that deadline in April, or if you have only left the UK within the last 6 years, that deadline's irrelevant. You can still apply. And what you need to do is make sure that you get at least 10 years, but you have to have worked in the UK for 3 of them. You should be absolutely reaching out to us. It's a money for jam opportunity, and I can't encourage you enough. And if you want to read the article, we can provide you that, as I said, and we will actually send it out to everyone who is registered for this because I think it's such a big opportunity. Just moving on, this is a quick example of people often don't believe me when I say that you can retire early. Now, again, this is for an example of a 35-year-old that we dealt with. I've obviously changed the name, but where they started basically contributing to a pension at 35. And over that 20-year period, I showed them a projection that they could reach a figure of 800,000, giving them 200,000 tax-free, an income of about 48,000 a year by virtue of making contributions of about €360 a month net. They had an employer matching contribution. And it was quite powerful just to do the exercise. Now, obviously, some of you may be older than 35 and may not be in a position to put as much. The best time to start is now. Honestly, I can't say that highly enough. I'm 51. I only really started funding my pension in my early to mid 40s. I had to start a business, and there are many other reasons, again, from a lifestyle perspective, having 4 children. But the fact of the matter is, it's never too late to start. But you need to try and take control and understand where you are and where you're trying to aim for. And by the way, everyone who has a pension scheme, you need to get a bit of advice around the funds that you're invested in. Another of the biggest mistakes that we often come across is that people don't take an aggressive enough approach with their pensions. I often ask, when I'm talking to people about these 3 different compartments that I spoke about, the short, medium, long term, they're taking less risk in their pension than they are with their investments. And I say to them, but your pension is your longest term investment. That's the one that has to be the riskiest, unquestionably, because you've got the longest time and it doesn't stop when you retire. It continues in your post-retirement years up until the time that you pass. And if you pass, it goes on to your next of kin. So you really need to consider, why would you de-risk your pension too early when you've got the ability to get growth year after year after year, not just pre-retirement, but also post-retirement? Tax. Tax is the biggest expense that we pay in our lifetimes. The example on the screen there, if you've got a couple earning 150,000 a year or an individual, you're paying over a third of that in tax every year. And if you try and invest some of the money that you earn, you pay tax on the growth. And if you try and give some of that money to your children, you pay further tax on that. It's a huge opportunity for people to consider how can they reduce the tax they pay. Four ways to do that. I've already spoken to you about pensions, and we can give you specific advice to help you navigate the best opportunity for you in that space. But there are others. The Employment Investment Incentive Scheme. Some of you who have listened to previous webinars will be familiar with that. That's something that I always encourage high rate taxpayers to consider as an opportunity to reduce the tax that they pay each year. I'm not going to dwell too much on that today, but again, we can provide you more information and give you guidance around how that could fit into your overall financial planning portfolio. Jack Chambers, the finance minister, stated recently that over 330,000 people, POA workers, overpaid taxes last year. There are tens of thousands of individuals that are not claiming back simple credits that they should do. And the government are encouraging individuals to do this. And it's really simple to use the revenue online system, ross.ie, to do so. And yet thousands upon thousands of people still are not doing it. Over 50% of people still haven't claimed the rental tax credit, which is worth up to 750 euros for the last 2 years for an individual, up to 1,500 euros for a couple, and it's now worth 1,000 euros a year. Claiming on things like tuition fees, medical expenses, and so on. And I'm still unsure as to why. Maybe it's because people don't understand how easy it is and they're afraid of bringing revenue on them. It's something I've done every year, and I've saved and got back thousands upon thousands of euros. And I've put it on the screen here, but again, we share this with you with the recording after the webinar today. But I would really encourage all of you, if you don't have an accountant, make sure that you use the revenue online system. I've touched on inheritance and gift tax. As a parent myself, it's something that I feel very strongly about, that we should at least understand and be aware that revenue will allow us to gift money to primarily children, but also other individuals, up to a certain allowance each year where they're not going to take any notice of that. The figure currently is 3,000 from one individual to another. Say, for example, one parent to one child. If there's two parents, that can be doubled to 6,000. Now, you might say, well, Nick, why are we going to give our kids 6,000 a year? I'm not asking you to give them the money. I'm suggesting that what you can do is you can start putting plans in place for them to start building up funds in their names where it's not going to potentially incur a tax liability for them in the future. Now, again, this is an area that we give specific guidance on. We've set up an actual plan to allow people to take advantage of this, where they get growth on their savings, but they're putting that money into trust in their children's names. And for any parents out there, and if you think about it, we're only allowed to gift our children up to 400,000 euros. If you've got one or two children, the value of your property is probably going to eat up almost all of that allowance. And when you add in any other assets and including pension funds, it is almost certain that they're going to pay tax on any gift that you give them. And a lot of parents may not either realize this, or they may not even be thinking of this, because obviously no one wants to think about 20, 30 years from now, and obviously the prospect of, whatever happens. The point that I'd like to make, though, is that it's something that you can address quite easily. It's something that we're all aspiring to do for our children, put money away for third level, help them get onto the property ladder. But you don't want to be giving large amounts of money to children at any given time. You want to be able to put it in a position where you're doing it continuously over a long period. That's the best advice that I can give parents on this call. Lastly, health insurance. There's over 1 million people who are reviewing or should be renewing and reviewing health insurance in January. And yet many people, hundreds of thousands, are not doing that. They're just letting their policies automatically renew. There's a huge opportunity to reduce costs in this. We give independent advice to individuals. Even if you've got a company plan, if you have choices within your company plan, you should be looking to see, can you reduce the cost of that? A lot of people think it's a free benefit, but you pay benefit in kind. And I see so many people who are on the wrong plans, so many people not taking advantage of online discounts. I've only ever paid for one of my children for health insurance, getting the others free by taking advantage of offers. All of the providers provide kids offers at different times of the year. And you just need to make sure that you navigate that. With regards to just summarizing, I've spoken about, putting a financial plan in place, doing a financial budgeter, just been a little bit more focused around what it is that you're trying to strive towards. Making sure that you've got some savings. I spoke about those three different pots. Dealing with debt. I'm conscious a lot of people obviously incur debt. Credit card debt being the one that I have the biggest issue with. And if anyone has a credit card that's not paid off every month, please do reach out to us and I'll help you reduce and get rid of that debt. I use a concept called snowballing, and I'd like to suggest that we can really help you focus on. And the biggest issue that I have with credit cards is the cost of interest. It's enormous. I still come across a lot of people that have savings in the bank earning zero and have loans with the same bank they're paying 7, 8% on. And it's just an understanding of how they might use their savings and treat debt like a form of savings to reduce the cost of that. Many people just get used to taking out car loans. And I have a big problem with car loans, not just because I accept why some people may have to take them, but they're normally offered to us and it just seems like an easy thing. And they're generally kind of lowish, like interest cost. But what they do is they stop you being able to pay more into your pension because you've got a direct debit coming out of your account that may not always be necessary. A lot of people carry company shares, and I always talk about having overexposure to one share. Continuously, I'm meeting people working for companies like Lilly, Google, Pepsi, and so on. They have 20, 30, 50, 100,000 euros worth of shares. And I always ask the same question to them. I say, if I gave you that money today, would you buy the same amount of shares in the same company? And pretty much 99% of people say no. And even those that say yes, it's because they have bias. And I say to them, but would you not maybe buy companies' shares in another company? And there are many other companies out there that would have outperformed the company they work for. We talk about the likes of Nvidia, Microsoft being probably two of the best performing shares last year. And all I'm saying is that it's really important just to get someone to reassess and help you independently evaluate where your positions are and navigating all of those financial challenges and decisions. Because it's really hard. I'm an expert in this. I've been a financial advisor for 27 years. I've run my own business for the last 11. And even at that, I'm saying to people, like, it's really about trying to kind of manage all those different kind of decisions that we have to make. And we provide this consultation process I mentioned. Basically, it gives you the ability to take advantage of the expertise of myself and my fellow colleague David Looney at a fixed fee of 199 euros. Many financial advisors charge significantly more than that. We have another consultation at 349 for individuals who have over 100,000 of investable assets or income of over 100 or combined income of 150,000. And we provide a number of reviews, getting a report to you, basically giving you an outline of your current financial position. We do all of the heavy lifting. And I think it's a really, really powerful service. And we will save you 10 times that in the initial consultation on a lot of the areas that I've touched upon, reducing costs of insurances, health insurance, your mortgage cost, helping you get the most out of your savings, better interest in your savings, and so on. Now, I appreciate I've spoken very quickly, but there's a lot to go through. Colleen, I know you mentioned that there's a few questions, so I'm more than happy to answer any of them if people are happy to stay on for a few more minutes.
So there's a good few questions around kind of lump sums, and I'll just fire one or two of them at you. So if you have a lump sum following a house sale, where would you save it for 5 years? And would you recommend the post office for a 5-year investment of that lump sum?
Definitely not the post office. Again, if you were paying attention earlier, the post office, bank, credit unions are everything less than 3 years. The answer really, and again, there's no one fits all. Depends. You obviously, if you've sold a property, I presume you've got no debt, but pay off all debt that you may have first. In terms of investments, what existing investments do you have currently? Have you covered all of the short-term obligations that you may have? Are you interested in looking at, buying or maybe buying a bigger property for yourself, do an extension? And once you've covered off all of those other points, the investments that I've touched upon earlier from the likes of the insurance companies with diversified portfolios that are, in my opinion, fantastic. But make sure you get them at the lowest fees and talk to an independent broker that isn't tied to one particular company. The likes of the Employment Investment Incentive Scheme. In my opinion, that would be a great opportunity for an individual if they're a high rate taxpayer, if they've got a large lump of money and they're looking to sort of diversify their investments. Are you maximizing your pension? That to me would be a massive opportunity if you had a lump sum. And you can always go back 1 year with your pension. So many people that get this lump sum haven't maximized their pension contribution for the previous year, in this case, 2024. That would be the first place I'd start.
In terms of the lump sum again, is it better to pay off your mortgage if you have a lot of savings, or should you consider investing it? What's your advice there?
I've sort of answered that in the previous one, but again, it's about the right balance and it's about talking to someone that can help you come to those decisions and give you the different pros and cons of each decision. But generally, it tends to be, doing a little bit in each of those. Some people are very averse to debt, so they may prefer to pay off the debt, even though they may be on a very low interest mortgage cost. But again, as I said, it really is a case of just looking at those three different strands that I spoke about and making sure that you've got the right balances and keep adapting them as you go.
With ECB rates possibly dropping to 2% this year, is one not better fixing with Trade Republic or raising?
Potentially, that's a good point. I was listening to a webinar earlier. There is a possibility that interest rates will fall further. It depends on what access you require. So, for example, if you need access to that money to pay for a holiday, perhaps, in the summer, yes, okay, you could fix it potentially for 3 to 6 months. I'm not convinced there's going to be as many rate cuts as you've alluded to, but certainly, yes. But those accounts allow you very simply, and they're very simple to navigate, and we can assist you with that, the option of either fixing or staying variable. The point being is that they'll always be market leading if you choose the right institution.
The S&P 500, would you have any thoughts on this?
Yeah. So the S&P 500 are the top 500 companies in the US. A lot of people refer to the stock market, and they're normally talking about the S&P 500. Most people who have a pension fund will have exposure to this. I'm not really keen on people just investing solely in that. It's only 500 companies out of a universe of over 4,000 companies. So I'm not convinced that's where your investment portfolio should lie. Again, it goes back to giving you that sort of full, universe of investment options. But anyone who is invested in the S&P 500 should be doing so, in my opinion, for a 5 to 10 year term.
And can you explain the difference between annuity versus ARF when it comes to pensions?
Annuities are a fixed pension. It's typically how everyone used to retire before, where you had a fixed amount paid to you when you drew your pension until the time that you pass. They're very rare in this environment. Very few of our clients will go on the annuity route. It's the ARF route. The ARF is basically a fund. When you retire, you get a payment that you can decide how much you want from that fund. That fund is still invested. So that's a big advantage to the fund, the ARF. And again, it's really important that you get proper advice from someone in terms of which option you're going to take, because an ARF is an investment and you've got choices as to which company you place that with.
And do you have to pay PRSI, and USC on AVCs?
When you say on it, no, you don't suffer PRSI and USC. If you make an AVC contribution, you get tax relief at source. So that €100 from your salary that's deducted, it only costs you 60.
What about the cost of buying back years before you decide to buy AVCs? You will get the same tax relief with guaranteed returns. What's your thoughts on that?
This is an absolute, but I'm not a big fan of people, teachers. I presume it's the teacher that asked that question of buying back a years. You do it at the end. What you do is you accumulate AVCs in a fund, you grow them, and then at the end, when you're looking to retire, you look back and decide how many years that you may want to make up for. A lot of the buyback years, by the way, that we've seen over the last year or two, they've actually proven to be cost ineffective. They've been too expensive, but I'm generally not a fan at all. But again, I did a specific webinar on this that I can share with you if you'd like to reach out to me after this. My email address is on the screen, by the way. You can just email me info@alphawealth.ie. I'll respond to any questions and I'll answer any questions that we haven't addressed today back to the individuals if you provide your contact details. But the financial consultation, as I said, is that review where we go through not just on a once off, but on an ongoing basis, not just for the first year, this is for all future years as part of that one-off payment.
So I've got two questions left and I'll wrap it up then, but there's tons of questions that we just haven't been able to get to. So one is I forgot to claim unemployment benefits when I was unemployed 2 years ago. Can I still claim these from revenue? I was unemployed for 5 months in the beginning of 2022.
I believe you can. Revenue allow you to go back 4 years to claim for things that you should have done. So again, a reason why I would encourage you to use the revenue online system. All of you should have used it and should use it for the fact that most of us are still working even partially from home. You can claim up to 30% of certain expenses that you suffer from lighting, heating, electricity, mobile phone. Yet we're still not doing that. So, but in answer to the question, yes, I believe you can.
And how can I reduce the tax outgoing as an employee already doing the pension and doing return on medical expenses?
There's many others that you can through the Ross system, and the drop-down menu will give you the list of all of those. So I won't go through all of them, but I'm sure there's probably a few more that you can claim on. Just to wrap up, again, we've just put up the last poll. I'm hoping that you took something from today's session. As I said, we're going to be running further sessions. The one that I'm doing on the UK state pension is the only paid webinar. It's a once-off cost of €99. There's a little bit in that, and I'm going to provide that service to give you everything that you need to apply for the UK state pension successfully for anyone who's worked in the UK for 3 years or more. That obviously includes the North of Ireland. For those of you that maybe you felt this hasn't met your objectives on, please feel free to give us some feedback. We are conscious that we want to make sure that we are meeting the objectives. You can log in for any future webinars on our website. My colleague David Looney is going to be doing a slightly more tailored version of what I've done today, really kind of mapping on from some of the areas that I've touched on. And again, please feel free to go onto our website and register for that for free.
Actually, somebody put up a comment, which is, yeah, we never stated whether 5 was best or worst. So hopefully 5 is best in everyone's opinion. So thanks. Yeah, we'll leave the chat open for anyone that wants to pop in any further questions, and Nick will address them following the end of the meeting. Thanks.
Great. Thank you very much, everyone, again for your time. I hope the year starts well for you and that the adverse weather hasn't affected you too much. And as I said, we look forward to talking to you again in the future. And anyone who would like to book that financial review can do so, obviously, either using the QR code that's on the screen there, or indeed just reach out to us. But you can book through our website, alphawealth.ie. Thanks very much again, guys, and I hope you enjoy the rest of the day. Take care.